Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And I have Laura Lau back on the channel. Laura, thanks so much for coming back on the channel. How are you?
I'm doing great, Adrian. How about you?
Good, I'm doing great. So in case you didn't know, guys, Laura Lau is the lead portfolio manager at Brompton Funds. And today we're going to talk about one of my personal favorite, if not my favorite, as you probably already know, split share funds of all time, GDV, the Global Dividend Growth Split Fund. So let's get into it right away. I'll just share my screen in case the audience wants to follow along here. And you guys could go on the website as well. So we're talking about this one. So this is a Canadian listed fund, guys. The stock symbol is GDV. There's of course GDV.PR.A. Those are the preferred shares, but we're gonna pretty much focus on GDV in today's discussion. So this is the Global Dividend Growth Split Fund. So the name kind of says it all, right, Laura? So let's first talk about the first thing we always need to talk about when we look at an ETF or a fund, the stock selection, right? So what can you tell me about how these stocks are selected? Obviously, the name of the fund says a lot, but go ahead, tell me about the stock selection.
So we're top down, bottom up. And what that really means is we look at the macro view, we look at the economy, we look at the stock market. Like, for instance, where are we in the stock market? Where are we in the economic cycle? Which countries, themes do we want? So, for instance, right now, we would say that we are more in the late cycle of the economy, where we have unemployment is very low,
Hmm.
inflation is starting to come down, interest rates are starting to come down. So in this kind of economic cycle, where we are, we like things like financials. With interest rates coming down, it's helping some of these financial stocks because we're people are worried about loan losses and such. So with some of the interest rates coming down, that will help financials. And then sectors are more important, but we also do look at which countries. And as I said, there's a number of themes that we really like at this point, such as artificial intelligence, energy transition, reshoring of industry back to North America. So we also try to play some of those themes.
Yeah, this is very, very well diversified. I said it before on the channel. This is pretty much one of the best diversified, not only in terms of sector, and you see the sector breakdown there, like you talked about, financials top of the list, but 20%. There's also technology at the top, which is really, really nice, which I like. I love tech stocks. Healthcare, industrials, you basically have a mishmash of every sector, but also the regional diversification. Obviously, we're going to see the highest portion in the United States. That's just where I believe that the best dividend stocks are. But you also see some other developed economies as well. So my question is, and if you scroll down, you could see the top 25 stocks here with the percentages. Correct me if I'm wrong, but like the name says, these are all dividend stocks, but you're choosing dividend stocks that tend to grow their dividend over time. That's why it's called dividend growers. That's also in the description. So how do you guys go about selecting these? Because you got a big array of stocks to choose from, I'm assuming. Plus, you're looking at the whole world. So it must be difficult to kind of choose what goes in and out of this fund. How do you do that on a day-to-day basis? I'm just curious.
That's a great question, Adrian. So, as I said, we try to figure out which areas we want to be in, which themes, which sectors, and then bottom up, we try to pick the best ones within that. So, first of all, one thing we do screen for is market capitalization. They have to be big, stable companies, at least 10 billion market cap Canadian.
Blue
They have a
chips. Yeah.
dividend. Yeah, they're blue chips, they grow their dividend. And one good question, I'm sure a lot of your viewers are wondering, like, why would you want dividend growers? And part of the reason is they tend to be very stable companies, and you have to have confidence in your future to pay a dividend and to grow it. So as a result, as I said, they're very good, solid blue chip companies, and they tend to outperform with lower volatility. The other thing we do is we also screen for technical analysis, and part of the reason we do that is you often see improvement in performance and sentiment even before it shows up in the fundamentals for earnings. So as I said, we try to choose the company with the best combination. We look at their business, we look at those fundamentals such as, good old-fashioned stock picking, profitability, return on equity, margins, moat. What can you do better than everybody else? And we also look at how well they allocate capital. What I mean by that is when you have excess money, what do you do with it? Do you try to improve your business? Do you try to grow it? Do you try to pay a dividend? Do you try to grow it? Do you try to buy other companies? And if you do buy other companies, what's your track record? Because some companies don't do a great job when they buy other companies. Sometimes they destroy value, or do you actually create value? And then, of course, valuation. So we're more what I call GARP, which stands for growth at a reasonable price, because you do get what you pay for. If you try to buy a very cheap company, sometimes it stays cheap forever because there's no reason for it to get better. So we do also look for catalysts to see if there's a company and what are they doing to improve their business.
So that's a lot of factors. Well, I'm happy you guys are doing all that work. I mean, I don't have time to do that, so this is fine. I love hearing this stuff from the portfolio manager. Much appreciated. Thanks for that. So another question I had. So this is an income-oriented type of vehicle. This is the Class A share of a split share fund. We'll talk a little bit about that later. I don't want to get into the whole details of split share funds, but let's talk about, and we kind of discussed this in our last Q&A, the covered calls and how you use options in this fund. So I'm just curious because it seems to be a fairly big portfolio. Those 25 stocks on your website said it makes up about 70% of the portfolio. So I'm assuming there's maybe 30, 35, something like that stocks in there. So do you guys use options tactically if you want to sell a stock or buy a stock? Like if you want to sell something, for example, will you write covered calls so with the intention of maybe it'll get called away? And do you use put options tactically as well for that, or no, we just do our regular covered call strategy to generate a little bit more income on top? I'm just curious about that whole options dynamic in the portfolio.
Yeah, so first of all, this is our most diversified split share. We typically have about 40 names. It can be anywhere from 38 to 42, and we deliberately
Okay.
make sure it is all around the world. And not everybody, like I would say, it's actually very difficult to write cover calls around the world. US isn't
Yeah.
bad, even Canada is hard, but Europe is very, very difficult to write. A lot of the brokers won't even let you do it on Europe. And, there's a lot of rules and regulations, and same with Asia. So first of all, it's not an easy thing to do on a global portfolio. And the way we do cover calls is we actually have an active approach, and it's total return. So as you
Okay.
said, we use the cover calls to generate income, and we also use it as discipline when to sell a stock. Like if we think it's trading at the high end of the range, then we will write there. And if it gets called away and assigned, that's fine. And we also look at the volatility. Are you getting paid to write
Right.
in that environment? Because sometimes what happens is in a bull market, your volatility, like such as now, is very low.
Yeah.
And when your volatility is low, you're actually not getting paid to write. You're actually better off just letting that stock ride and get those capital gains. So that's something that we look at very carefully, and we can buy puts in order to buy a stock at a lower price. But in practice, it's not always easy to do because we do have to pay a distribution on a monthly basis for the Class A shares. We typically do write about a little bit out of the money. It can be anywhere from 3 to 8%. Sometimes on tech, which is a very volatile sector,
Yeah.
sometimes we can write 10 to 20%. Sometimes on energy, we can also write, 5 to 12%, 20%. It depends on the market environment. We take that into consideration whenever we do write. We look at the sectors, we look at the stock. So we're very active and we customize that strategy for that stock.
Makes complete sense to me, and I've had these discussions with other members from Brompton. Total return is the most important thing. You take an active approach. You don't overdo it on the cover calls. Yes, you're adding a little bit of income, but like you said, especially with the stocks outside the U.S., the options market are not as liquid, not as developed, and it makes sense that you're saying, for tech and energy, we could get more premium because those are typically a little bit more volatile. So thanks for that. That it makes complete sense to me. One thing that I really like about this fund now, it's over 5 years that it's been out. So after 1 year, 3 years, okay, it's still a bit early, but now we passed the 5 year mark, and I have to say, I was looking at the performance numbers. I was extremely impressed. I mean, if we just go to, and if hopefully it's big enough for the audience. If not, you guys could just go on the website and follow along. But if you just click on performance, you'll see the total returns right here for the Class A share. So this is total returns. This basically simulates as if you're reinvesting the distributions, right? It's capital plus the dividends together. And if we look at the last 5 years, the average annual return is just under 13%. This is pretty incredible. This is pretty much, similar to S&P 500, if not a little bit more type of returns, which is absolutely incredible considering, there's some global, first of all, it's only dividend stocks and it's globally diversified. What do you attribute this magnificent performance to?
As you said, it's magnificent performance, especially considering we haven't really been able to hold the Magnificent Seven. So we have
Exactly. Yeah.
Microsoft and Apple, but a lot of those other magnificent stocks didn't pay a dividend. They just started initiating what I call a token dividend. So,
Yeah.
we're starting to look at those to see if we should add. But I think the way we've been able to do that is that we have been able to, look at themes and say, where do you think the money should be? Because really 70% of the stock market now is US. And when you look at it, Canada's underperformed, Europe's
Yeah.
underperformed. But what we try to do is when we go around the world, we look at themes and we go, what is every area good at? What I mean by that is Europe. What is Europe good at? You know, what Europe is good at is brands. So we go there for luxury brands like LVMH. What we're also there for now is civil aviation. What I mean by that is you've seen there's problems with Boeing. So who benefits from that? We've actually got some civil aviation in Europe that has taken advantage of that. The other thing is we look and say, the future, what is the future going to look like? So we definitely see, for instance, the energy transition. So how do we play that energy transition? So the top holding we have there is Train. So one thing that's not well known is a lot of the energy we use is actually for buildings. So for Europe, half of the heat, the energy used is for buildings, because you have to think they're old, drafty buildings.
Yeah.
So we have, heating and cooling. Train is there. So what they do is, have better, air, and also how can you have better heating and cooling systems so you burn less energy. So we've had energy transition stories like that, like Williams. It's got the best natural gas pipelines in North America. So it's become actually a bit of a stealth AI play. Why? And energy transition play. So what do you need for the energy transition? Well, you need a lot of transmission lines, especially over states. In the U.S., Williams, they build the most of them. And then they have the best natural gas pipeline network. So when we're talking to Williams, we saw them, a couple of months ago, and when they're actually talking to data centers and such, they're talking to them about building natural gas plants close to the data centers. They're talking about trying to build natural gas plants for them, because the truth is these AI data centers use a lot of electricity. And how are you going to get that electricity? Because you need steady electricity, not just when the sun shines for solar or when the wind blows for wind. So they need steady power, and natural
Right.
gas gives you that. The other thing we've done is look at other, I'd say other themes would be, we call it diabesity or diabetes and obesity. So certainly with that, we've seen that these drugs like Ozempic and such, they've been doing very well. So, we have Lilly there to take advantage of that. So
Yeah. I
we
mean,
do, look long term. And in terms of tech with AI, we have a number of plays there. Of course, Microsoft and Apple's been a laggard, but I think today they're supposed to be making some announcements, and I think Apple will be announcing, AI phones and other things to try to keep up, and an update of Siri, because right now update Siri doesn't work that well. But we do think that there are a lot of upgrades that can be made to Siri.
Wow, yeah, I mean, the diversification is incredible. There's healthcare, there's industrial. You talked about some industrial stocks in there, healthcare stocks, even technology, right? Apple, Microsoft, they do give a dividend, so they are in here. So I really like you're very energetic. You obviously know, you follow these companies. That's not something I have the time to do, or probably the audience has to do. So I'm very, I'm glad I'm hearing this from the portfolio manager. You're obviously tracking companies that you believe in, but you're very knowledgeable on what's going on with them, and the future. Like you said, we're focused on the future. So yeah, and believe it or not, I mean, there's a lot of names in here, especially the ones outside North America. I had no idea what they do. And just a trick for my audience real quick, what you could do is you just just put it in Google, and you'll see the company, the stock symbol, and you'll get a description of what they do. And it could actually be very, very useful. And I started looking at these companies like this one, and Train, like you talked about, and Williams, and looking at the stock charts, they're pretty impressive. They just seem to be going up. They have a little dividend, it's growing. So this is obviously really good stock selection. And I'm glad that you guys are really taking the time to pick and choose the right companies. And obviously, the performance speaks for itself. So I have to give you props. I got to give you congratulations because it's kind of hard to beat the S&P 500, which is, like you said, most of the returns comes from the growth stocks, the Magnificent Seven, which most of them are not here, but you seem to have done really, really well performance. So one thing I want to talk about, and this is really one of the funner things about split share funds, they're closed-end funds, right? There's a market price or the stock price, and then there's a net asset value. And we discussed this in the previous Q&A as well for the other split fund. But it's very, very rare. I've been invested in this one myself for a while. I've been following it for a long time. I don't think I've ever seen it, or it's been very, very rare where it's trading at a discount. So in case my audience doesn't know, what does that mean? Well, the stock price, this is as of June 7th, so it's obviously June, we're filming this on June 10th, so it could be different, but as of June 7th, the stock price ended at about $10, $9.92, but the NAV, sorry, that's the unit NAV, the net asset value of the Class A shares of GDV, you see here it's 10.07, so it's actually trading at a discount, right? The intrinsic value is actually higher than the stock price. So how rare is this? I know that maybe you could give us some, just out of top of your head, some estimate figures. I personally can't remember in the last 5 years GDV trading at a discount, only in the last couple of minutes. So do you think this is a fantastic opportunity? How rare is this opportunity?
As you said, Adrian, it is very rare because usually over 70% of the time it trades at a premium.
Premium, yeah, the opposite.
And the average premium is 8.3%. So now you're actually getting it at a discount. Whenever you get something at a discount, that's a good deal.
Yeah. Yeah, and this is not something ETFs really, ETFs are open-ended, so typically the stock price is the same as the net asset value, but these are closed-end funds. So this is where a closed-end fund could be a very special way to, as an indicator that, okay, now it's a really good time to get in it. So, it's no coincidence we're actually doing the video now. I personally think it's a great time to get into GDV. I personally invested some money into it myself. I have a big position in it personally. So very, very exciting stuff. So Laura, I know you're busy. I'm not going to keep you on here forever. Last thing I want to discuss is the distribution policy or the dividend policy of GDV. So in terms of the Class A shares, it is a split share fund. Most, if not all, split share funds have a rule where the unit NAV, which is now at $20, which is very high, has to be at least $15 for the monthly payout for GDV Class A shares to be paid out, which is 10 cents. I have to point out that GDV in the last 5 years, or since it's been out, has never ever missed a monthly distribution, which is great. So do you have any comments on that? Are you guys really focused on making sure that the net asset value is strong to be able to sustain these distributions? Because I know it is a fairly big concern for income-oriented investors, or investors that are buying GDV for the income, for example. Do you have any comments on that?
So as you said, we pay out 10 cents a month, so it's about 12% yield.
Yeah.
And now with the combined NAV over $20, you have a big cushion before $15.
Yeah.
Before we do have to cut the distribution of the Class A. So I very carefully I really try to keep that NAV above $15 because that's why investors buy this fund. They want consistent, steady performance so that they can get their dividend.
Yeah, and I'm assuming it's a lot easier to do with this type of diversified fund than a sector-specific one, where if you have one stock or you have all financials, you're kind of at the mercy of that sector. Whereas here, we saw this beautiful diversification. You got healthcare, you got technology, you got financials, and plus you have regional diversification. Do you feel that your job is easier with this fund than maybe some other split funds? Hopefully, my question is making sense.
Yes, definitely. The more diversified you have your portfolio, the more there's some place you can hide, or something goes up, something goes down, right?
Exactly. Yeah.
Offset it. Because, for instance, if you have a split that only has one stock, there's absolutely nothing you can do.
Right.
Whereas we have a portfolio where we can pretty well go anywhere. We can go anywhere in the world, but we keep to developed markets. And as I said, we're also very careful on the risk management side because we do know we don't want big drawdowns because that people get nervous, and so that's why we do a lot of the risk management side, diversification between sectors, countries, and we also use the option program to try to lock in gains as well.
Awesome. Awesome. Laura, I have to say, I really love this fund. I personally have over 100,000 of it, of my own money in it. I know my viewers love it as well. Very nice diversification, awesome performance. I'm talking to my audience here, a really special time to pick some up because it's very, very rare that it's, trading at a discount. Like Laura said, over 70% of the time it's trading at a premium of an average of 8% premium or more, I think it was. So Laura, thanks again so much. Thank you so much for taking the time. Obviously, you're very passionate and you're following the stocks and managing this portfolio actively, which we appreciate. So hope to have you on the channel and we'll talk soon. Thank you so much.
Thank you, Adrian.